Okay, well, we are going live. Welcome everyone to the CleanStart Perspectives. I am Thomas Hall, and if you like what we're doing here, please make sure that you click the like and subscribe button and leave a comment if you have any questions with what we're doing today. So I want to thank the people who have sponsored us and help us build this clean economy in Sacramento. That's SMUD, Blue Tech Valley, and the California Mobility Center and River City Bank. All of them work and serve as kind of legs of stools propping up the clean tech ecosystem, helping us accelerate the energy transition right here. We're actually going to get to hear from one of our sponsors today, which I'm really excited about, especially if you've been following any of the news on banking. This is going to be a good perspective. I also want to thank the individuals out there who support us with their donations. They help, as I always say, feed my crippling Red Bull addiction. I very much appreciate it, and so does Red Bull. All right, and with that, I would like to welcome Rosa, Senior VP and Director of the Clean Energy Division at River City Bank. Now, Rosa is so the River City Bank services for clean energy companies. They help clean energy companies from 2 to 30 million. Under her stewardship, the bank has become a clean energy leader in California, serving the majority of the state's CCAs, that's the community choice aggregators, helping finance renewable energy projects and supporting other local sustainability efforts. She's been with the bank since 2014 and has been running the Clean Energy Division that was established in 2018. So I'm going to welcome Rosa to give us a little bit of more background, and I'm going to stop sharing.
Thank you, Thomas. I appreciate that. And I know that title is a mouthful, but it's very descriptive. Most banks, at least of our size, don't have specific clean energy divisions. I'm very proud to have been a part of pioneering that for River City Bank, which is a local Sacramento bank. So for those of you in the Sacramento region, you'll no doubt know us. In addition to being a local Sacramento bank and having a specific niche within the clean energy sector, I am proud to announce that we're actually celebrating our 50 years in banking this year. So 50 years ago, 1973, River City Bank was founded in Sacramento. Fast forward to now, I'm sitting here in our San Francisco office where our clean energy division is headquartered. I can probably see a little bit of rain here as we're getting the same rain you guys are in Sacramento. And I'm happy to be here. We're a proud sponsor of CleanStart Sacramento. And I think there's some burning questions out there on many of your minds.
I know.
Getting a lot of phone calls. Yeah. And, I thought it would be good to maybe start with just, some high-level overview of what's happening in the banking sector, specifically the recent bank failures that occurred over the last week. It feels like it's been a month, but it's really only been a week since everything occurred. And so, Thomas, I know you have some questions, but did you want me just to give a quick overview, or do you want to dive into specific questions?
Yeah, why don't you give us kind of the high overview of, I guess, banking in the Silicon Valley Bank that had the recent failure and takeover. Maybe, what were some of the causes of that, and what are all the banks the same with this risk, or how do other banks handle this situation?
Yeah, no, it's a great question. So I guess I'll address the second part of your question first, and the answer is no. Not all banks are created equal, and not all banks have the specific risks that occurred for SCB and Signature Bank, which is a cryptocurrency bank out of New York, the second bank that failed in the past week. Looking at kind of all the financials and all the different variables that cause bank failures, if we take a step back and think about, the 2008 financial crisis, most of that was related to bad debt. So loans that were made that didn't get repaid, which caused sort of a debt crisis. And historically, if you look at bank failures, that's typically what causes the bank to fail. It's poor risk management on loan underwriting, and that can cause challenges for the bank that result in losses. That's not what happened here. What happened here was really a subsector of two things. So one would be heavy industry concentrations, such as venture capital and cryptocurrency markets. That in itself isn't a bad thing. There's a lot of good things about having industry concentrations, especially for, perhaps I'm biased since my whole division is specifically within the clean energy industry. And some of the pros that come with having industry concentration is that you become sort of a subject matter expert in certain subsectors of an industry. It also provides you with some economies of scale, and you can better service your clients. It's also easier from a business development standpoint. You do one deal within, a specific sector, and now you know how that works and you can do more. So there's a lot of benefits for having industry concentrations, but those concentrations have to be managed appropriately, and there has to be, proper risk management practices in place. Obviously, the cons of having industry concentrations can be that, any shock to that particular industry can have a negative impact on the bank, as we've seen with the two banks that failed recently. I don't want to oversimplify it, because it's definitely not just because these banks were industry heavy in specific industries that caused them to fail. Ultimately, I think the biggest risk here is interest rate risk management. As I think everybody that's listening knows, the Fed has been increasing interest rates pretty rapidly. In fact, more rapidly than ever in history. We've seen just a steep increase in interest rates over the last year or so. And if not managed appropriately, that can cause significant risk to banks and other companies. But banks in particular, interest rate risk management is sort of considered banking basics. It's like the number one risk that a bank has to make sure that it's monitoring. Obviously, credit quality is another important one. They're all important, but there's sort of pillars there in terms of what can happen when interest rates rise rapidly. So specifically, in the case of the two banks that failed recently, their investment securities portfolios heavily were bet in such a way, or invested in such a way, that there was a bet that interest rates wouldn't rise as rapidly as they had. And so when the Fed embarked to tighten monetary policy, there was exposure. And so a simple way, without getting too nerdy into the details, a simple way to manage that risk for banks is to manage the duration of your portfolio. For example, for River City Bank and many banks, that duration of your securities portfolio is, 1.5 years or so. In the case of some of the banks that recently failed, they were closer to 7 to 10 years. And when you've got, think about how much a treasury security was just 2 years ago, yielding basically nothing. Today, rates have increased rapidly, and so when you're stuck holding a long duration securities portfolio that hasn't been hedged appropriately, and there's a liquidity issue that happens and you're forced to liquidate, it can cause losses, as we've seen. And so that sort of caused the ripple effect and ultimately market panic and good old-fashioned run on the banks, which was sad to see. But it's one of those things where if you had money there, you weren't sure if it was insured appropriately or what would happen. It's sort of a sad reality that there was just a flight to safety.
Mm-hmm.
So so that's an overview. Hopefully that wasn't too detailed for you, but curious what other questions you may have.
Oh yeah. So you have I guess let's kind of talk about, confidence in the banking sector here. One thing that I've seen going around is that 73 of the last 73 kind of bank collapses, the depositors have always been backed up. And a lot of people making the run on Silicon Valley Bank, they had this fear that their deposits wouldn't be kind of backed up. And from listening to you, it sounds like for the risk when it comes to interest, the T-bill, the federal rate, that River City Bank has been addressing these these risks by, hedging so that they're not exposed to them. But what would this mean to someone who would want to come in, let's say, take a loan from River City Bank? Does this impact their ability to get loans? Does this impact their how might this impact their projects?
Yeah, that's a great question. Most of the questions I've been getting recently have been, around deposits and deposit safety. But you do raise a good question on what's the impact on loans. For River City Bank, we are not impacted directly, and so my answer today is the same as it would have been a month ago, a year ago. We manage what we price loans at based on market. And market trends have been such that interest rates have been going up. And so I guess the answer to your question really depends on what the Fed does next. There is actually Fed meetings happening today and tomorrow. There's an expected announcement on Fed policy. And so don't have a crystal ball. They could continue down the path of increasing interest rate. They could, decide to halt. They could even decide to reduce, which personally is probably unlikely, since, we still have the inflation problem, which is the whole point of increasing interest rates, is just to slow down inflation. And so the answer to that, it depends. But banks as a whole and River City Bank in particular, we're very in tune with what's happening in the market for market pricing. And we, adjust interest rates accordingly.
Well, that's good to hear. So for the overall banking sector, what does this kind of mean? And what's its impact for, I guess, CleanTech and the VC sectors?
Yeah. So overall banking sector, I think the jury's still out on that topic in particular. So I can give you my personal opinion as a banker and someone who studied economic history. And, you can also read, through some headlines. There's definitely, some publications that, are very much concerned about systemic bank failures and, sort of a ripple effect, which definitely we should consider that and look at, what risks are at other institutions. And I suspect regulators are going to really focus on that area, in coming exams. Like I said, I feel like the focus has historically been on credit quality, which is very important. But I'm assuming the shift from a regulatory perspective will focus a little bit more on interest rate risk management and liquidity. Two, personally, I look at this situation as more of an opportunity because, whenever there's panic, it creates opportunities. It's sort of how our economy works. And I can say for River City Bank and some other banks out there that I've been talking to, we've actually had a net inflow of depositors over the last week. And that's simply because there's some concerns around, there's been clients that have been coming from some of the banks that failed, and then some other banks that, may be, not as secure at the moment. And so there's definitely been sort of an influx of potential depositors. And I'm looking at this also as an opportunity to look at, how can we grow the loan side as well as the deposit side. So obviously I'm a little bit more optimistic than some of the headlines out there, but I think that's kind of where I stand today. That may change, but as of today, that's my position. And I mentioned the regulatory component. I think that's, whenever there is a bank failure, history has shown that, regulations will tighten. You did mention something important that I wanted to address about, depositors, being backstopped regardless of FDIC insurance. I think that the statement by the government on that definitely helped to quell panic. In fact, I was just reading an article this morning from the American Banker, which shared that Janet Yellen sort of reaffirmed her position that the government is going to do whatever it needs to ensure that the banking industry is safe and sound. And so whatever that means in terms of monetary policy, we'll see tomorrow. But I think that does definitely provide some comfort to depositors. Now, in the past, so if you think about kind of the controversy between bank bailouts for our most recent history in the global financial crisis of 2008, that was really borne by taxpayers. It was government funded. Some of it was borne by private industry with forced mergers, but a majority of it was probably arguably borne by taxpayers. In this instance, Janet Yellen and the federal government has come out and stated that taxpayers will not carry the burden, and that it will be the banking system itself. So what does that mean? Every depositor, whether you're aware of it or not, there is a fraction of fees that go into paying FDIC insurance through the banking system, and that's how the pool of the FDIC insurance fund is funded. Think of it just like an insurance premium. Now, depending on what happens with the banks that are currently in FDIC receivership, there could still be buyers for those banks. That's probably the most likely scenario versus liquidation, but jury's still out on that. So what that means is, you'll likely see those FDIC insurance fees that the banks have to charge depositors go up. And so ultimately it's the banking industry that bears that burden, and some of that may trickle down into just overall lower yield on deposits, despite the recent rising interest rates. But that's my hunch. We'll see how it all unfolds.
Well, yeah, one thing that you said there that I think, I like to echo to, startups is that, when you look for, look for opportunity through diversity. And it sounds like kind of River City Bank, has taken, good risk management steps to protect people and to make sure that the bank stays solvent. But also at the same time, you're looking at working, with clean energy, which is still relatively new, CCAs, which are still relatively new, and hopefully new technologies, which are inherently risky. So how does, a bank that wants to, that, has been leading on innovation in the clean energy sector balance the risk from going into a new sector with being a responsibly, I guess, I don't know how to put it, run bank and for the rest of their depositors?
Yeah, that's really well said. It comes down to calculated and very disciplined risk taking. As a banker, specifically in the commercial banking sector, I have to be right 99.9% of the time on loans that we make, because banks are run in a way where we can't take venture capital risk. We don't get paid venture capital returns, so we can't take those risks. And it, like you mentioned, it wouldn't be prudent for our depositors and our investors. And so I look at each credit opportunity and look at, well, what are the specific risks that are associated with this borrower? What are the industry risks that are associated with this borrower? And you sort of have to think of worst case scenarios and then think of, well, how do I mitigate those risks? Can they be mitigated by certain loan structures? Can they be mitigated by guarantees? Are there loan structuring components that we can put in place that help mitigate, those risks? And so it's all about risk and mitigation. That's kind of the job description of a commercial banker. And so you have to have solid practices in place to make sure that you're making sound judgments. And I think, as far as clean energy and clean tech, we obviously work with, more established companies. We do work with some startups, more on the deposit side, not necessarily on the loan side. And there are some sort of later stage startups that we do work with that have, guarantees, or either from the sponsors, or the owners of the company, and or from government programs through the state or the Fed. And so that helps mitigate some of that risk. but ultimately we've got to be prudent in the way that we manage that. The importance of the venture capital sector and the private equity sector, so any sort of investment vehicle within the clean tech space in particular, I think is crucial for the banking sector to get up to speed and get comfortable, because you need the the equity investment, the more of the risky capital in place in order to prove a technology works, prove that a project works, and then a bank like River City Bank can take a look at it and evaluate if it is an opportunity that makes sense for a bank loan.
So how long or how often, I guess, so let's say, I'm a clean tech startup. I've gotten some venture money, maybe getting into that space where it's like, okay, they're getting to that 2 million sort of value space that, River City Banks works with. You assume that they have some sort of controller or, accountant there. How often should they, meet with their banker, and what kind of discussions should they have to make sure, one, they're addressing their risk and I guess their duties to the bank and reporting, but also so they can take advantage or, build a relationship that they can take advantage to help successfully grow their company.
Yeah. Are you referring to kind of the topic of making sure that their deposits are safe with the bank, or are you talking about
I'd say just good, partner management.
Yeah.
They probably shouldn't call you every day asking if their deposit's safe, or it'll just be a short phone call. Yes, it is.
I'll pick up the phone, but that wouldn't be an effective use of your time. So I'll address. I think there's two things in there. So one, kind of the topic on everyone's mind right now is deposit safety because of what's happening with FDIC receivership. And so some advice that I can give is, familiarize yourself with what portion of your deposits are FDIC insured. There's a lot of material out there. A quick conversation with your banker, and feel free to reach out to me after this discussion. I'm happy to help you guys out. There are ways that you can structure accounts where, you can maximize your FDIC insurance. And so that way you can kind of sleep easy and not have to worry, is the government going to cover all of my deposits if a bank fails? Because that's sort of at the whim and prerogative of the government at that moment in time, because, the FDIC insurance does only cover, typically it's $250,000, but there are, like I said, ways to maximize that. Two, there are, not a lot of people know about this, but there are products out there that can actually maximize your FDIC insurance so that all of your funds are covered. I won't go into the details here, but if you're curious, you can give me a call and we can talk about it. I've got clients that have, millions of dollars insured with the FDIC through partnership product that we have. And so I suspect that those types of services and products are going to become a little bit more frequent and popular now that there's some unease in the market. But, they've been around for decades and something that, some subsectors of customers are familiar with, others are not. And it's just a matter of getting to know that from your banker. Two, don't be afraid to ask your banker questions about the health of the bank's financials. As bankers, we're used to asking you all the tough questions about, what are the risks in your business? Like, when are you going to, reach, this amount of profitability, or, how are you growing your revenues and your overall profit in your business? And so it's okay to ask that of your banker. In fact, I encourage you to. I think it's good to know a little bit more about the bank that you're with. And I'm always happy to talk more about River City Bank's financials if anybody's curious. We are publicly traded, so that information is public, and it's a good conversation to have with your bankers, especially at this moment in history.
Mm-hmm.
So that covers the.
Well,
Sorry, go
just
ahead,
as
Tom.
you're talking about that, how will people contact you best, Rosa, to talk about this, and
Yeah,
particularly,
uh,
um,
sure.
increasing the percentage of your deposits that may be FDIC insured through your partnership program?
Yeah, definitely. So my contact information is on our website. You go to rivercitybank.com/cleanenergy, and my contact information is there. My email is my first dot last name at rivercitybank.com, and my phone numbers are on the website as well. And I'm happy to share that with you and Thomas, and feel free to publish that to the attendees here if you like.
Excellent. I had a question, but Gary, you've been somewhat quiet. I know you have questions.
Well, I've just been checking around with some of the people that are in our CleanTech cluster to see, what's the level of anxiety, and remarkably lower than I thought.
Yeah.
People understand they have to do their job in managing risk as well, but much as you've indicated, strong movement towards diversifying the banks that they deal with. Multiple accounts, things that they would ordinarily think of doing to offset the risk. But, for example, on the topic we were just talking about there, and in the conversations you can have with your bank, how do people find out what your risk management practices are? I'm fairly sharp difference in terms of the duration of securities. Silicon Valley Bank being out there really on the long end, that surprised me. But is it just conversations that reveal that sort of thing, or is it reported somewhere, and maybe in the future will have to be reported?
Yeah, it's a great question, Gary. So most of the conversations I've had with clients and prospects and other folks in the industry is mostly just been conversations. So myself, our CEO, Steve Fleming, and I have had some calls with clients as well, just to talk about, how River City Bank manages risk. But we don't expect anybody to be an expert in the banking sector. It is a very unique set of practices. It's different than any other industry, and we certainly don't expect anybody to be an expert. But now that, some of these risks have come to light, there's plenty of materials out there in articles that have been written that kind of indicate kind of what the core issues and what to look at in financials. And I guess the short answer to your question is that most of the information is going to be in the annual financial report or quarterly financial reports that are released by the banks. And to the extent there are credit ratings, those reports can also be helpful. But ultimately, having a trusted relationship with your banker, and then having that, conversation with your banker, and or, folks on the senior management team of the bank, I think is the best place to start.
As a startup, you should get really comfortable reading financial statements too.
Yeah.
You're going to have a rocky road if you don't know how to read them.
Yeah, right. You need to learn how to read the table of contents and get to the right page.
Mm-hmm.
But that's
so
a skill
lot of,
that's probably good to acquire.
Yeah. I always, people might think it's boring, but, I think it's always been kind of, it's somewhat exciting. We have a banking system, the fractional reserve banking system, which, if people don't, know what that is, that's where a certain percent of deposits can be reloanable funds and investable funds. And that's really, honestly unlocked a lot of the growth in historically for everyone in it. It's also kind of that weakness in it, whereas if everyone comes and demands their money back right now, like they did at Silicon Valley Bank, that's a risk. So we have the, FDIC insurance, we have the Fed and the Treasury that take steps to make sure that people can be confident in their bank. And it sounds like, people that, are literally have called you asking, to get the reassurances on, is their money safe in the bank on it? And from what I hear, the answer is, yes, there's additional products that you can get additional security if you're concerned, which, might be very reasonable if you're holding a lot of money into the bank. and that, for the most part, River City Bank is continuing with their plans going forward. Sounds like there's been, you've been able to convince people that you're safe enough that it's increased deposits, which is a great thing. And Ed Fletcher, who's on this call, and I both run another nonprofit that's banks at River City Bank. So that's good to hear our small amount is safe there.
Thank you for your business. We appreciate it.
What other?
Yeah, it's yeah.
I was gonna say, what other products or services does River City Bank that have that support, these smaller companies, local companies, and CleanTech?
Yeah, no, that's a great question. Well, I mean, the bread and butter of any bank is deposits. Deposit growth is what fuels a bank growth. And so if you're a local startup in the clean energy sector and you're looking for a new home for your deposits, or even looking to diversify, give us a call. We'd love to do business with you. And so, and deposits is sort of a larger umbrella, that includes various cash management services. It also includes, things like, interest-bearing accounts, checking accounts. It includes the, full FDIC insured products that I talked about. So there's kind of a wide range of kind of general services that fall under that. Then there's the credit component. And so for customers that are looking for credit, whether it's line of credit to fund your business operations, or equipment loans to finance purchase of new equipment for your business, or if it's project finance and you need funds to complete a clean energy project and you've got contracts in place, that's also something that we are experts in. The startup banking is not generally something that we provide credit to, but as I mentioned, there are a few that have kind of fallen into that late stage startup, and you've got revenues, you've got some profits, you've got a good sound backing, and we've been able to help those companies with loans, specifically through state-run guarantee programs like the ClimateTech guarantee. I did a webinar on that just last week, and I think that'll be posted on our website shortly, and I'll be sure to share it with Thomas and Gary, so those that are interested can get information on that. But ultimately, there's so many wide arrays of credit needs, and I'm always happy to take a meeting. Even if you think your company may not be ready for bank financing, give me a call. I'm happy to give you my 2 cents on what I think in terms of where you are and your growth. And it's always great to connect with startups in the industry for, I think, 2 reasons. One, I'm always curious, what's the next big thing in clean tech? And I always love to learn. 2, we never know if there's something that we can do now or if it's down the road. It's always good to network. And I guess the third one is, there may be other connections that we can help each other with within the industry itself. So I hope some of you, if we haven't met before, that you'll reach out, and I'd be happy to set up a meeting with your company and your investors if you think it's warranted.
And for the startups out there watching, I just want to boost absolutely what she said on that. We've had a lot of, you guys asked about, where do I find partners and things? Well, you don't just find partners in the technology business development space. You find them with your, with accountants. You find them with law firms. You find them with your bank. And you might not be ready for that, that big firm or that, that big step in project finance. But the more that you work with the bank, the more that you're going to know the steps that you need to get there. The more that, when you're ready, you have someone that you have had discussions with, so that you hopefully have, more confidence in what's going and what's happening and the whole process. It's a lot easier to go and learn about, project financing for right now, as opposed to, maybe 3 years when you actually need to do one. Because it's a pain, it's a lot of work. And it's, it is where right now where a lot of pretty much all the energy projects to get done. Project finance. I wanted to toss it to Gary to see if you had one last question, and then.
Well, yeah, one last one. So I got to make it a big one. The feature recently is all this money that's nominally been made available through the infrastructure bill and the Inflation Reduction Act. And in this state, it's amplified even more by what's in the state budget and how that's moving around. The consequence of which is there's a lot of sources of contract and grant money now for startups. Some of them come with some strings attached that you have to be part of a community group. Some of it requires matching money. But overall, this is very encouraging to people. But there can be 90 to 120 days lags between when you spend the money and when you get reimbursed by the government. So the increased attention on dealing with cash flow is something that a lot of our companies worry about. To date, the only decent advice we've given them is, well, if you're going to be in the contracts and grants game, get more than one, with the hope that the 90-day lags don't line up so where you're always going to be 90 days out of pocket. But that's advice like do good and avoid evil. So I know that banks are reluctant, and certainly the companies are reluctant to put personal guarantees up, but there are other things. There are like restrictions on how low your cash can go, triggers some intensified scrutiny, etc. And so this always seems to come up in our conversations with our smallest clients about a banking relationship and why it's important. So that's one part. Since I've only got one, the other part is now a number of companies have come forward and said, gee, I've been approached by this new thing, crowdfunding lending. Putting those two words together sends a chill up my spine. But I don't know whether you've seen much of that and, whether you have a notion on it. So that could be a different layer of banking. So only drop those in your lap.
Sure. You didn't make that one easy. So I'll address the first part of your question first about the timing lag between receipt of a grant and when you actually get the cash from the grant. I do get a call. I do get a lot of calls on that one. I have successfully funded one loan that sort of bridged a gap between grant funding and completion of a project. It was a battery storage project. The grant was through the SCHIP program in California, which is a very established program. We got comfortable with the source of funding and sort of the conditions. But there was one thing I think you said, that there was a reluctance of personal guarantees, and I think that may be a non-starter for banks. It certainly would be for us if it's sort of a startup or no additional source of revenue outside of the grant fund, because if anything happens, project doesn't get placed in service or something falls through with the grant, there is no source of repayment. And going back to Tom's question earlier about, well, how does the bank, make sure it's making safe loans? We have to underwrite to sort of the worst case scenario. So, one of the things I get is that people don't want to put up their house or their personal guarantee on the startup, but you're also asking the bank to believe in you. And it's easier for me to believe in you if you believe in yourself and are ready to sign on the dotted line with me. That's always kind of my pitch. But of course, every situation is different. And, we give a good, honest look on every opportunity, and we'll give you honest feedback on what the bank needs to see in order to underwrite a loan like that. The other thing is, there are these other types of guarantee programs through the state or the federal government that may fit for something like this. And so, if you've got grant funding for a project and need some sort of bridge, let me know. Always happy to brainstorm and see if there's an opportunity there. I will say that sometimes it's challenging for banks to do short-term bridge financing because there's a lot of work an expense that goes into making that loan. And if you're just going to get paid off in, 3 months, it may not necessarily be worth it for either party, because there's, transaction costs involved as well for the borrower. And so thinking about, how you can structure it in a way that kind of makes sense for both parties is something that I'll throw out there on that question. Does that answer the first part of your question, Gary? Or
Yeah,
do
it
you have
does.
follow-ups there?
And, I think we all appreciate how creative your bank is willing to be on this. You're willing to consider lots of opportunities, but let's go on to the frightening part of my question.
Yeah. So crowdfunding is a concept that's been around for a long time. I don't know much about it and not an expert in it, but ultimately I view that as alternative financing. And so it's probably more akin to, VC or private equity type of convertible note, where it's technically a loan, but, you're paying higher returns because it's not a bank that's underwriting you. It's sort of a group of individuals that have pooled their money together, and then, some administrator is lending that money out. Crowdfunding has worked well in countries that don't have very stable financial markets, so think developing countries. And it's also worked in scenarios where you need a very small loan amount. So it, maybe, just a few $1,000s, or, I've not seen crowdfunding work for, millions of dollars in the past. And so that's the only thing I can provide information on there. But very interesting question. And, who knows, maybe there will be some form of crowdfunding to help the clean energy transition with some investments. But I kind of put that in the equity bucket more than the debt bucket, because it acts a little bit more like equity.
Yeah, no, I've watched this grow over the years. Now it's common to be offered $500,000, things like, they're called lending circles. I don't know what to make of it. And I worry about what are their hooks if you fail to repay their loan. Does somebody show up with a baseball bat and going to break your kneecaps, or what goes on?
Well, hopefully not. Yeah, I actually don't know. I don't think crowdfunding is as regulated either as banking. No. So that does pose an interesting point on what the recourse is there.
Well, it's been very educational to have you on here. And I think the important point is people need to think beyond the news on Silicon Valley Bank, and a good opportunity.
Yes, I would agree.
To be reminded of the importance of building a relationship and getting started on a relation with the bank. And I think we all appreciate how creative River City Bank has been over the last 50 years. You've supported a lot of things that have paid off well for the communities as well as you. So, we just want to continue people's trend towards developing deeper relationships with, the smaller banks that, are more interested in getting to know their depositors at a networking type level.
Yeah, couldn't agree with you more there. Thank you both for having me. Again, I will share that my contact information is on rivercitybank.com/cleanenergy. And Thomas and Gary also have permission to share my contact info with anybody that reaches out.
That's fantastic.
So thank you very much, Rosa, for joining us today. If you're out there, like and subscribe, and, share this content, and you can reach out to us at thomas@cleanstart.org, or you can go visit rivercitybank.com, because as we've mentioned, talk to your bankers. You don't have to look at the news to get your info on the health of your bank. You can follow up, build that relationship, and hopefully turn it into something long-term that gets your company growing in the future. So thank you for attending. For those of you out there, make sure that you follow us and watch us on Facebook, Twitter, LinkedIn, YouTube. There's also Empower Innovation Network, which you can go check out for partnerships. And thank you very much today. And that's all we have. See you guys in hopefully 2 days to talk about plants.
Yeah. And our meetup coming up Thursday night. So we'll be there with drinks and pizza.
Yeah.
at the California Mobility Center. A little too far a drive for you, Rosa, but for other people who are watching,